Hello everyone. I hope that all is well so far. I just want us to take our learning unit to the next level. Remember, we talked about the overall uh, sections of our unit, and we did introduce the financial statements, and we mentioned the fact that the financial statements need to be interpreted in order for them to make sense to the users. Remember, we compile these books because we have got users, people who are going to use the financial statements in order to make decisions. Now I want us to further interpret the financial statements in the form of ratios. Sometimes it's advisable for us to express figures according to the ratios because they are easy to read. Without wasting time, let's look at the types of ratios. As you can see here, the first one is called the cross-sectional analysis. This means that is where we compile ratios and compare the performance of two different companies, for example. For example, here I can compare Varsity College and Boston College and check which company performs better. Again, we can use what we call the time series. What do we mean by saying time series? Here it means that we are comparing year one and year two for the same business or for various businesses, but we focus mainly on what? On the periods. You see, the first one is the cross-sectional. It means we compare different firms. And the second one is time period. It means we compare different periods. Please make sure that you know the theory around these particular ratios. And again, we've got what we call the combined analysis. What do we mean? Here we mean that we can combine the two, that we can use the cross-sectional and at the same time we can use the time series. And again, we can use the benchmarking. The benchmarking is where we use the performance of other businesses to judge our own performance. In other words, our performance is based on the performance of the other companies. We say, okay, the other company is making a profit of 20%. It means that will be our benchmark. It means we're going to make sure that we are equivalent to that 20% or we exceed that particular 20%. Please, for more information, please go to the manual for more information. Now, we've got categories of ratios here. Why do we compile those ratios? Is because we need to check the profitability of what? Of the business. How profitable is the business? Remember, is where we are gonna express, for example, a profit. Let's say we made a profit of 2 million. We're gonna say, for example, we made a profit of what? Of 60% this month. So we are gonna calculate ratios where we express those ratios in the form of what? Of a percentage. That will be regarded as what? As the ratio. Again, we need to check the liquidity of the business. Remember, we talked more about the liquidity of the business. It means we are able to cover our current liabilities using our current assets. Okay, so again, we've got what we call the liquidity ratios. Now we've got the asset usage. In other words, how effective do we use our assets? Remember, when you have got assets which belongs to the business, you need to use those assets for the benefit of the business. For example, let's say you've got a vehicle and that vehicle is for the business. You need to make sure that you use the vehicle for the benefit of the business. Don't use the vehicle to transport your friends maybe to a party. No, that is not effective use. The assets need to be used effectively so that at the end of the day, we end up making what? Profit. Debt ratios. What do we mean by say debt? The other term is liability. Remember, sometimes we need loans, sometimes we buy goods on credit. We classify that as what? As debt. So we need to check whether we are using too much debt to finance the business or not. Remember, we either finance the business using the debt or the loans, or we can use our own equity. Remember, if you've got more debt, yes, you can gear your business. The financial gearing is high, but there's a risk of not being able to pay back the debt. We call that financial risk. Okay, so again, we need to balance the use of debt and the equity within our business. The last category here is market investors. Remember, if we are running a business, we have got people who invested in our business. So those people expect something in return, for example, in the form of dividends. Again, there are ratios which will indicate to those shareholders whether the business is performing or not. Let's look at those ratios. First, we've got liquidity ratios. The first ratio under liquidity, we've got what we call the current ratio. And the current ratio, remember, we check how many times assets cover the current liabilities. So you need to know this formula. The current assets, we divide them by what? By the current liabilities. Or you can say current assets is to current liabilities. The other ratio is called acid test or quick ratio. This ratio is similar to the current asset. As you can see, you just have to take the current assets, you minus the inventory. This is inventory, and you divide by what? The current liabilities. Remember, the financial statements will be given to you so that you can be able to go and extract this information. For example, if you need assets, you need to be given the statement of financial position for you to be able to go and extract the figure for the current asset so that you can be able to calculate these ratios. So your role at the moment is to know the formula so that you can be able to know which information to use. Let's talk about the activity ratios. As you can see here, we talked about the efficient use of the assets. The first one is called the inventory turnover. When you talk about the inventory turnover, we just have to check how many times does the business replace the inventory during the period. It means the more times we replace, the better the business performance. It means we are selling more. So we need more times to replace. Because if I can replace 20 times and you replace only 2 times, it means my business is doing better. So this is the formula that we need to use. The other one, we've got the average collection policy. Remember that when you are selling to the customers, sometimes we sell to our customers on credit, sometimes we sell for cash. The minute you sell on credit, it means you are going to have what you call debtors. The other term for debtors is accounts receivable. So the average collection period ratio means how long does it take us to collect from debtors. So it is better for us to have fewer days to collect from debtors. For example, if my business collects within 20 days and yours collects within 40 days, it means my business is doing better because I can collect within fewer days. So please also know the formula. As you can see, you need to multiply by the 365 so that your answer can be in the form of days. The other one, which is the opposite of the one that I just talked about, is the average payment period. The average payment period is, for example, how long does it take us to pay back our creditors? Remember, our creditors are the same as accounts payable. So when you buy goods on credit, it means you will end up having creditors. So now the creditors normally give you the period within which you must pay back the money. So we need to have more days to pay so that we can have time to go and collect from our debtors. So to show that the ratio is favorable, here we want to have more days. So if you have I can have more days to pay, it's good for us. But here under average collection, we need lesser days because we're the ones who are collecting. This means that these two ratios are interrelated. So I collect from my debtors and I can use that money to pay my creditors. So if your creditors days are less than your debtors, that doesn't make sense because it means you have to pay your creditors before you collect from your debtors. The other ratio is called the total asset turnover. like we said, we need to have the efficient use of assets in order for us to be able to generate income. This ratio means how effective or efficient is the use of asset in order for us to generate turnover. Remember, the turnover is the same as the sales. So if we use assets effectively, it means our turnover is going to be more. So again, this ratio will tell us whether we are performing better or not. Debt ratio, remember I said debt ratio is all about the balancing between the debt and our own money. The first ratio here, as you can see, debt ratio, it means you have to take your total liabilities and you divide by what the total assets. In other words, we're comparing the use of liabilities against the use of assets. If the use of liabilities are high, it means you're going to have the highest percentage. As you can see here, we multiply by 100 so that the answer can be a percentage. So we need to make sure that we check whether we are highly geared. If we're highly geared, it means at the end of the day, we used more liabilities. Yes, you can use more liabilities so that we can expand, but at the same time, you must look at whether you will be able to pay back the loans which you have. So we are trying to balance the two at the end of the day. The other ratio is called the time interest earned. In other words, how many times does our profit cover interest? For example, here you can see this is EBIT. EBIT means earnings before interest and tax. Earnings is the same as the profit. So it's just the profit before interest and tax. So we need to check how many times does our profit cover interest charges. Interest charges like the interest on loans, the interest or on debentures. So we need more times. If you've got more times when you're comparing two companies, it means your business is performing better because it's better for you to cover the interest many times so that you can have money, profit available after paying what? The interest. The profitability ratios, as you can see here, we've got the gross profit margin, we've got the net profit margin. Remember the word gross, it means this profit is, we still have to deduct other expenses so that we can have net. Remember when we went through the formats, you need to know the format so that you can be able to know which one is gross profit and which one is net profit. So for you to calculate the gross profit, you need to take the gross profit and divide by the turnover. Turnover is the same as sales, and your answer must be expressed in the form of what? Of a percentage. Again, the net profit margin, you have to take the net profit after tax. In other words, on the financial statement, like the income statement, or you can call it the statement of profit and loss, you must go and find the profit that is after tax. And you take that profit, you divide by the turnover. The turnover is the same as the sales, and you multiply by what? By 100. Now we've got the earnings per share. The earnings per share is, for example, if the shareholders bought shares from your company. So at the end of the day, the profit that we make, we can determine how much does each and every share make as a profit. Like you can see here, we've got earnings per share. This is the same as the profit per share. Every share that I have, it generates a particular profit. So I can know the profit for each and every share. This means NPAT means the net profit after tax is the same as this one, the net profit after tax. Just the abbreviation there. Okay. The profitability ratios continue. We've got the return on assets. The return on assets, again, the efficient use of asset. How much did the asset give us as a profit? Okay, so you say the net profit after tax, again, you divide by the total what? Assets. Again, guys, here, you must multiply by 100, just multiply this by 100 to make it a percentage, okay? Again, we've got the return on equity. Again, net profit after tax, and we divide by the total equity. Equity is the same as capital. So again, it's all about using those ratios effectively. Again, here, guys, make sure that you multiply it by what? By 100. And again here, multiply by the 100 so that it can be easier for us to compare. We've got the market ratios. Remember when I introduced this topic, I said there are ratios which will focus on the success of the business. So as investors, we are interested in market ratio. The first ratio is called the price earnings ratio. This ratio shows us the confidence of the shareholders into the business performance. In other words, as you can see here, we take the market price per share and we divide by what? by the earnings per share. So the higher the price earnings ratio, the higher the confidence of those particular shareholders. Okay. Again, we have got what we call the market or book value ratio. Again, this one, it shows like how do the shareholders perceive our performance? Can you see now? So we compare the price per ordinary shares and book value. Remember, the market price is according to the market itself or JSE, and the book value is according to the value in our books. So again, these ratios can be used by investors in order to make decisions. Please make sure that you go and learn these ratios so that by the time when we calculate, everything makes sense. Okay, thank you very much, and I appreciate your attendance in this matter. Thank you very much, guys.